We're ready to go. So good afternoon. My name is Paul Barter. We are recording this event today. This is part of our E2E Survival Toolkit. It's one of a bi-weekly series of events we're doing to deliver value to entrepreneurs and startups while we're challenged with the COVID-19 scenario that's underway. So today's event is really the number one thing that startups and entrepreneurs ask us about at the RIC Centre and our partner incubators and accelerators, and that is, how do I go about raising money? So today we're going to let you hear from both investors and from a founder that has gone through the process of raising money recently, and we'll give you kind of both sides of the discussion. There'll be lots of time for Q&A at the end. I will have about 15 minutes of Q&A. I'm going to remind you to keep your microphones muted in the short term. And then as we get to the end, if you have any questions, please post them in the chat, and I'll read off the questions as we go. So again, my name is Paul Barter. I think I probably know most of you. I'm an entrepreneur in residence at the RIC Centre. And I'm actually going to pass it over to one of my peers, David Harris-Collada, who's another EIR at the RIC Centre, to introduce our first speaker today. So David, over to you.
Thanks, Paul. Hey, everyone. I just wanted to say a few words about Scott, as I'd invited him to join us today. And Scott's a seasoned venture capitalist, and he and I have co-invested in a company together recently, and that was raising an early stage round. And we also are both interested in prop tech in our investing parts of our careers. So we look at deals together, and he's just a great guy. Always has a unique take on things, and I think you'll enjoy having him present today. So Scott, thanks for joining us.
Thanks, David. Thanks for the intro. Thanks, Paul, as well, and for everyone at the RIC Centre for having me on the line today. Hopefully everyone can hear me relatively well. I've been asked to do a bit of a presentation on where the venture capital world is during and I guess coming out of COVID, and how to potentially access capital during that time. So I've prepared a little bit of a slide deck, which I'll take you through right now. Obviously, the most interesting part of these types of discussions tends to come out in the Q&A, so hopefully we can get through some of the slides, and we'll pique your curiosity, and we'll be able to have a good dialogue. So give me one moment. Okay, hopefully you guys can see this deck here. So we'll get going. First, a little bit about me and GroundBreak Ventures. GroundBreak Ventures is a VC firm. We're headquartered in Toronto, Ontario. We focus specifically on investing in early stage property technology companies. Our focus is in the pre-seed to Series A for a first check of somewhere between $100,000 if you're closer to the pre-seed side, to $1 million if you're closer to the Series A side, with the intent on writing 2 or more checks to a company as they grow and develop their business. And we are supported by the Hopewell Group of Companies, which is a company based out of Calgary, Alberta. It's a multifaceted real estate organization with a US and Canadian footprint. And it really touches all corners of the real estate world. So it gives us a bit of a competitive edge in terms of evaluating potential opportunities. And also a place whereby potential entrepreneurs, emerging companies can pilot different projects, can potentially work with a customer closely to develop something. And they touch, the areas that they touch include home building, both single family and multifamily, development, commercial and residential, property management, and logistics. So they span a pretty comprehensive look at what's going on in real estate at any given time. They're in 6 provinces and 3 states. And our thesis is pretty simple. We believe the real estate world is changing probably much faster than most people think. It seems like COVID is going to accelerate some of that change and some of that thinking. And so we are simply imagining how and where people live and work. And that mandate is pretty broad, and I think it's pretty broad on purpose, so as to not put unnecessary parameters and close in on what we can do. And if you would like to learn some more about our thesis and some of the stuff that we are working on, please feel free to check out our website at www.groundbreakventures.com. So why did we choose to get into prop tech? I'll keep this part pretty brief. Real estate is a massive asset class globally, $35 trillion in the US alone. And as you can probably appreciate, construction companies and real estate companies have been slow to innovate and they haven't invested in R&D. So quite simply, there's this massive market opportunity, there's a slow innovation cycle, and that generally means that it's ripe for disruption and or disintermediation. And there's been a lot of excitement around prop tech for probably the last 4 or 5 years, where it's really kind of come into its own as a niche within the venture asset class broadly. And so getting to the meat of it, the impact of COVID-19 and the environment that we're seeing right now, I mean, suffice it to say, things are going to be slower and it's going to be a lot more difficult to raise capital. And so we've kind of outlined what we think some of our peers are doing, what the venture community is doing more broadly, and then specifically what GroundBreak is doing during this time. And so, you know, there are some really harsh realities that I think entrepreneurs need to be aware of for where VCs sit at the moment. So there are instances within my immediate peer group of LPs that are pulling out of their commitments with respect to what they said they would invest in funds. There have been instances of LPs not meeting capital calls when a VC is calling for that capital. And there have been instances whereby VCs in general are backing into deals where they have already made commitments. So these are the stark realities. These realities aren't made necessarily because the LP has ulterior motives or whether the VC doesn't like the deal, but there are very practical business realities that are being dealt with right now, and the impact is just that. So I think we need to kind of set the context about what's going on in the marketplace. So in Canada, what we're basically hearing is a lot of waiting and seeing, biding time, continuing to look at companies, continuing to do diligence, but not being particularly active in terms of pulling the trigger on deals, which is clearly understandable given that the macro environment is moving so quickly and we're trying to assess how risk has changed. And there's definitely an inward focus whereby existing venture funds are doing their best to support their existing portfolio and create an avenue and extend the runway for those companies that they've already invested in, so that they can bide enough time to get through some of the slow period that we're going to be going through right now. So there's a lot of inward focus in the industry. There's a lot of supporting of their own, and there's not a lot of reaching out for new opportunities, which really just means that the overall environment, which is always hard to raise capital, is just that much harder. But the good news is there are active funds, and depending on where you are in terms of staging your capital, you may be well positioned to take advantage of some opportunities that are presenting themselves in the market. And so that kind of takes us a little bit into GroundBreak's approach right now. Quite frankly, we are fortunate. We got off the ground in the early part of 2019. We've deployed about 8% of our available capital. And so we actually have a lot of dry powder at this time to continue to work forward and look for new investments and close new investments. So inside of GroundBreak, what we're trying to do is maintain our investment pace. And what that means for us is that we're looking to do somewhere between 5 to 10 deals a year, depending on the size of those transactions. And we're also trying to take this opportunity to reach out into new markets that are previously a bit untapped for us. So we're spending time prospecting into different cities, including a couple cities that may be a bit unusual. We're looking into Atlanta, we're looking into Washington, D.C., areas that maybe would have been a little bit harder for us to reach into prior. But now some opportunities have opened up whereby entrepreneurs are looking further afield for investment dollars, and that's given us the opportunity to get into new markets and potentially new deal opportunities that would have been somewhat more difficult for us previously. And I think the other point that's worth making is while most funds are encouraging their investee companies to extend their runway, to pare back expenses, et cetera, we are trying to encourage some of our companies to be a little bit more opportunistic, both in terms of hiring from firms that maybe are going through a hard time, and with respect to evaluating potential M&A alternatives that may emerge during this time frame, so that those companies can be better positioned to come out the other side. And so overall, our mantra at GroundBreak right now is be aggressive through this downturn, but don't be heroic. And we're in a fortunate position to be able to say that, given, as I said, where our funding cycle is right now. And we're really trying to put our money where our mouth is and build our reputation through the downturn by being an active fund and by being a good partner that's truly helping out companies at the time that they need it most. So we've already signed 2 term sheets post-COVID for net new company investments. One transaction in the US has already closed, and we're highly confident in the other Canadian investment, because you'll be hearing from one of the founders later in this presentation. And the key is, what we're finding is our biggest advantage in the marketplace right now is, even though we're a relatively modest fund, as you can tell, the check sizes that we write are not massive. We're in a very interesting position to attempt to help companies catalyze their investment rounds. And so for any of you who have been out there trying to raise money before, and this goes for whether you're a venture fund or whether you're an entrepreneur, the hardest thing to do in any market at any time is to find a lead. And this is true pretty much in every geography and really at every stage of your capital creation chain. So what we've been able to do is, even though our check sizes are relatively modest, we've been able to get out there to find deals that we like, tell the world that we like those deals, help price those deals and value those deals, and create that spark that can allow for momentum to be created around a deal to ultimately get to completion. And so I think that's one of the things that is sort of our biggest advantage right now. And as you will see, when you're trying to raise money, that lead is the hardest thing to come by. Once you kind of have something established, finding the rest of the money to round out a financing is generally something that can be doable. And we just, generally speaking, feel like this time frame right now, the next sort of 12 to 18 months, we're going to probably end up doing the best deals that we will ever do within the context of this fund, given what's happened in the marketplace. And so this slide is just to take a look at what are we looking for in this post-COVID environment. And I'm still working out parts of this first point, which is the main thesis here, but we're trying to find companies that can capitalize on what I'm kind of calling this forced technology adoption that we're all experiencing right now. We're all working from home, and even those of us in our, I'm now in my 40s, but even of those in our 40s, 50s, 60s, we're learning to use tools and technologies that we may have been reticent to adapt prior, because we've had to, frankly. And so those tools are like collaboration tools as simple as Microsoft Teams. They're workflow tools, depending on your industry, that are basically replacing paper processes. They're anything to do with remote access and monitoring. And they're anything to do with what is going to be required for the work from home environment, which has to do with privacy, security, compliance. And so if you think about these buckets right now that I'm discussing, they're just kind of meat and potato things that we probably should have been doing, that we always put off, that we never really wanted to deal with learning, that we have now been forced to learn, and that now is the opportunity for those things to really ramp and scale. And so it's that kind of meat and potato bucket that we're looking for right now. And so all the other more sort of deep tech ideas, anything to do with quantum computing or glass solar panels that are going to be put on buildings, that's all great stuff, and we'll get to that over time. But let's focus on what I think is going to work coming out of this crisis, and that is actually pretty straightforward technology adoption. And then obviously, we're trying to find a little bit more tangible traction in the market that we may have been okay with otherwise. So that doesn't necessarily mean that you have to have 5 million in revenue and complete product market fit. But at every stage of the investment cycle that we're looking for, we would like to see a little bit more validation within the field, a little bit more buy-in from clients, focus a little bit more of our diligence on how the clients are using those tools and technologies before being willing to pull the trigger on a deal. So a little bit of de-risking in terms of tangible market traction. Again, recognizing that depending on what stage you are, that is either going to be easier or harder to validate. And then we're looking for management teams that can adapt and recognize, and I think this is important, recognize that the world has changed. It's changed operationally in terms of how businesses need to be run, and it's changed financially in terms of where money is going to come from. And I've written a piece internally to my LPs, which talks about the 5 stages of grief and where entrepreneurs are in that 5 stages of grief cycle. So my advice to anyone here on the line is sort of get out of that denial and anger, those phases, as quickly as you can, and get through to acceptance of the new reality, acceptance that things have changed, and move forward as quickly as you can. That's what we're looking for in our entrepreneurs. And frankly, I still kind of feel that we're more in that anger bargaining stage than we are in acceptance as it stands here today. And then, of course, we're going to look for some kind of a unique angle, probably more so than we would have traditionally, and I'll get to that later in the presentation. So just some pieces, some slides I've put together about understanding how to raise capital. And I think first and foremost, it has to start with entrepreneurs spending the time to think about how a VC themselves think. And we're actually pretty simple characters at the end of the day. We really need 2 things. We need a dream, a big opportunity, big blue ocean, and we need credibility, the team that's going to be able to deliver on that dream. And that's what every VC is looking for in pretty much every investment that they make. And why is that so important? Well, because 20 to 30% of a VC's winners need to carry the entire portfolio. And if anyone's interested, I can walk through a full presentation that I've done on this to outline all of the math that goes behind this. And the realities of how a VC constructs their portfolio is that when you factor in the failure rates, you factor in the dilution that occurs over time within your portfolio, and you factor in, most importantly, time, your portfolio returns erode exceptionally quickly. And the dirty secret in VC is that it is an exceptionally hard asset class. All we ever hear about in the news and in different tech journals is about the next unicorn or Norwal, as it is in Canada. But the reality is that mean and median VC returns have historically, throughout pretty much every cohort over the last 20 years, been below the S&P 500 and NASDAQ returns. And just to give you some context, in 2017, I think the NASDAQ was up 28%. In 2019, the NASDAQ was up 35%. And these are completely liquid. You can get in and out of your investment anytime you want. So this is kind of the world with which a VC is competing against. And that means that, focusing on how you buy something, how you invest, the VCs aren't there to beat you up. They're there to figure out how can they actually make a return that makes them competitive across asset classes. Because if they can't attract capital, then you as entrepreneurs aren't going to get capital. And so, the first starting point here is size really does matter. And this is a slide I put together for founders and entrepreneurs to sort of take a step back and be a bit honest with themselves about the type of business that they're building. For a VC to generate a 20% IRR, which is sort of, at least let's call it the target, I think average returns in the US VC world are high single digits, and in Canada, they're low single digits, just to give you some perspective. So to generate a 20% IRR and deploy large amounts of capital, VCs are really looking for opportunities that offer that significant blue sky with a large addressable market, and typically are focused on a platform offering versus a single product or point solution, as we often say. So on the right-hand side, you see things that are not VC fundable, but perfectly good businesses, something that's growing, 20 to 30 to 40% per year, that can generate profitability or at least cash flow, positive cash flow. And something on the bottom right, which is a VC fundable business where there's real investment capital needed early on, but that growth can double, triple, quadruple into the out years as that business scales. And so asking yourself, is your business VC fundable? Do these elements describe the venture you're embarking upon? Is really important as you get going. And equally important is that a VC doesn't define what you're doing with a business. VCs are not the be-all and the end-all. We all like to talk about VC investment and as I said, these sort of these pre-money valuations that get talked about around the water cooler when there were water coolers. But not all businesses or ideas or concepts are appropriate for VC investment, and that's totally okay as it relates to making money. There are plenty of ways to monetize ideas and IP that have nothing to do with venture, that are all very legitimate strategies and have all been extremely successful, that I've seen people make a ton of money in my career. And so some of those options are license and royalty deals, partnerships, revenue shares with someone that's already in the market, where they may be your distribution channel, you may be providing a piece of technology into that channel. And then, of course, bootstrapping, that could be a better option. If your market size is not as big as what is required for a VC fundable business, or has lower capital intensity, perhaps bootstrapping, whereby you keep a bigger piece of the pie, is the better option. And maybe you can leverage government incentives and grant programs, or maybe you can find customers that will build and pilot with you to get your business, to get your product developed and get you over the hump. So just because you can't find money from a VC does not mean that all is lost, and frankly does not mean that you can't make a ton of money over the course of your career. And so I've got a few slides here about raising capital. You'll note some key points that are going to be sort of described over and over again here, but keep your valuation ask proportionate to the opportunity. And this is extremely important. Not every company that someone is looking to build is going to be worth $1 billion. And if you're looking for an exit that is in the sort of $40 to $50 million range realistically, you have to be able to stage your different rounds of financing accordingly, so that every single funder along your capital creation chain has the ability to make money commensurate with the risk that they're taking. And one of the things I find super helpful, because this is what VCs do when they look and do their analysis on whether there's an appropriate return multiple for them before making an investment, so it makes sense for the entrepreneur to think this way, is work backwards from where you think you will end up, and work backwards from where you feel subsequent rounds can be done at. So in other words, if you're raising a seed round with XYZ deliverables, if you're successful on delivering those things within reason, is there enough room on the table for those seed investors to make money when you go and look to raise your A round? And so for a seed investor, think in terms of this. You need somewhere between a 2 to 3 times lift into the A on paper before thinking that you're going to be able to make that investment. And if you're doing your A round into a B, you should be looking for at least a 2x lift. So does the math work? So when you work backwards, are you leaving that amount of money on the table for your investor or not? Because if not, you're going to find yourself in a very difficult position once that first round is raised, because you need to find the next dollar of capital into your subsequent round. And although that may be frustrating in the sense that there's a more dilution up front than you may have anticipated when you run the math, remember that it's all paper money without an exit. And the single worst mistake that entrepreneurs and founders make is messing up that capital creation chain, pushing the valuation too high too soon, finding then it is impossible or very difficult to raise money for the next round, and ultimately probably having to do a down round, which is not something that you would want to have to do, but more importantly, costing you valuable time. So again, taking a real opportunity to look at your market environment, look at your addressable market, not just what you can write down on the page in terms of how big something is, but how big can you really get this thing, and working backwards from an exit or from your next round to understand where to price your current round. That's what all VCs are going to do, so you might as well do that work on your end. And then I guess lastly here, in terms of this COVID world and a post-COVID adjustment, I think everyone should expect that their valuation expectations will be reduced. And again, that's totally okay. There's nothing wrong with with leaving a little bit on the table in the earlier stages. The reality of COVID is we're going to go through a recession, growth is going to slow, and so pricing of risk has to change alongside that. And frankly, I think it's healthier for both the entrepreneurs and for the investors. On the investor side, they can probably get a better valuation. But on the founder and the entrepreneur side, the expectations to try to grow your business so quickly, perhaps at a speed that isn't commensurate with what you're able to do or with the hiring that you're looking to achieve, is okay. Slow down and do it right. And so I've got through a few lessons that I've got here from my past experience in fundraising. And the first one is be careful with angels. Angel investors are, fantastic in the early days. They are necessary, often help get a business off the ground. The challenge is that they often do not have a very sophisticated view on risk. They can easily be sold a dream, and they don't really necessarily understand all the ins and outs of the competitive environment. And the result tends to be that entrepreneurs negotiate favorable terms with angels at lofty valuations. And as I mentioned on the previous slide, where is that next dollar of capital going to come from? You quickly get stuck and you waste your most precious resource, which is time. So be careful with angels. Pushing for a higher valuation is not the answer. It's all paper money. So try to be proactive. Try to, even if you take money from angels, try to go outside and get an institutional view on value. And perhaps you even go back to your angel group and give them a better deal, because ultimately it's worth it for you in the long run to keep that capital creation chain healthy than it is to push the value early on. Lesson number 2 is beware of the strategic lure. Now, strategics are a bit of a double-edged sword. Just be careful when attracting this type of capital, because they often have motives that are different from your average investor and certainly from a VC. So they may ask for things like distribution rights or regional exclusivity, or they may take a position in your company that is a sort of a defensive stake, a 20% plus stake, let's say, or they may ask for right of first refusal on sale. All of those things are going to impact your ability to do your next round. All of those things are going to be warning signs for a VC when it comes to that next round of financing. And interestingly, it can also be very rational for a strategic to overpay and to overpay on purpose. So a strategic can be quite wise in this sense. If they give you a big valuation that no one else can, and they know you're going to get stuck in and that you're unable to find financing once they're in, they know that they're the only source for financing when you need to come back to the market. And that will allow them to increase their stake in your business at an even more punitive valuation, because they know that you will run out of options. So be very careful with putting things in whatever agreement you make with the strategic that can turn away potential further investors down your capital creation chain, and be very concerned about them offering a price that is too good to be true. And I guess the last point that we're kind of experiencing now that I have on this slide is, in a downturn like the one we're about to go through, it's going to test the resolve of that strategic. And so are they going to be there when you need them? Are they going to be able to continue to fund you? These are all questions that we don't know the answer to, but they're certainly less likely to push forward in an asset class that is probably a nice to have for them relative to their core business. So if you go the strategic route, and it can be quite fine, 2 strategics are better than 1. At least you can create a healthy competitive dynamic between the 2. Lesson number 3, don't be too clever by half. Never compromise on your investment structure for the sake of valuation. Clean capital tables are worth it. Plain vanilla shareholder agreements are worth it. Really work hard to minimize the bells and whistles, the ratchets, the double dips, the participating preferred shares. All of these elements make subsequent rounds of raising capital more and more difficult. So give up on the valuation to keep your term sheet, your capital structure as clean as possible. You got a whole world of professionals here, lawyers, bankers, analysts, VCs that are always trying to show how clever and how smart they are. We believe that smart is simple, and all we have to do is find a valuation that works for both parties. We don't need all the other bells and whistles attached. And lesson number 4, you probably can tell from the conversation so far, is don't obsess over dilution. Time is much, much more valuable than the few percentage points you may leave on the table by negotiating a valuation that you're a little bit less than satisfied with. And if capital is available, again, to the point of dilution, just take it within reason. There's no point in skimping. The adage that everything takes twice as long and costs twice as much is completely. And interestingly, overcapitalizing gives you options that you didn't even know that you wanted. And I think this is important, especially right now. maybe there's a hire that all of a sudden becomes available that's generally pricey, but you raise an extra 500 grand in your last round. Well, maybe you can now go and attract that person. Or maybe there's an M&A opportunity that's out there and you can strike a deal with a little bit of upfront cash and an equity contribution to roll a business in. All of these things that you didn't even know that you want happen and are available to you if you have the capital, especially during a downturn. So if you were fortunate to raise money ahead of the downturn, fantastic. If you're fortunate enough to get a term sheet now, raise as much as you can, again, within reason, and assuming that you've listened to slide number 3, not being too clever by half. If you've kept your capital table simple and clean, it's easier for you to be able to take more money today. And then I guess the last section is trying to differentiate yourself in a post-COVID-19 world. I think some of these things are probably obvious, but in case they aren't, we'll walk through them. Have you leveraged all the non-dilutive funding sources that may be available to you? So have you looked at IRAP? Have you looked at FedDev, NSERC, BDC? A number of programs have been announced. There are always more programs than you might imagine out there. You can check out a website called thefundingportal.com that can help you search for incentive programs that may be valuable to you. I know that it was free at a point to do these searches. I don't know if it is today. There are also grant writers that work on a contingency basis that you can hire. This can be a very valuable resource for you in terms of time, unless this happens to be a skill set that you're particularly good at because you know your industry. Either way, make sure you're leveraging as much of these sources as you can during this downtime. Investors love the idea of being able to provide the equity capital that can be levered into these types of programs. And a lot of the programs do require matching funds. So get the biggest bang out of the buck that you possibly can from the equity dollars that you can raise. And have you evaluated M&A alternatives that may broaden your scope or broaden your business? I think this is a critical one that probably most entrepreneurs and founders don't think enough about. Is there an opportunity for someone, is there an opportunity with another entity in your space where you've had some dialogue, you recognize they're doing some interesting things, maybe you've even had some good conversations, and perhaps together you can have a bit of a broader offering, again, speaking more to that platform than a point solution. Perhaps there is an alternative available for you to work with that company very directly right now. It's a downturn, everyone's looking for things to do, perhaps more of a team, a broader team, more depth of team, a bigger offering, a bigger addressable market can come out of those types of discussions. In my opinion, Canada is very guilty of having too many opportunities, chasing too few investment dollars. So why not get together and create a better platform that is more fundable for a VC? This is an interesting time to do that analysis, to have those discussions. Have you worked to leverage the commitments that you do have within your syndicate? This is kind of going back to sort of name dropping and other strategic players that you might have already attracted to your company. Make sure you are leveraging them and their networks as much as possible. Be sure you can ask them to use their name when going marketing. Be sure that you are not shy about asking for access to their network if possible. And tie your use of proceeds as clearly as possible to value inflection points. This is another critical point to think through right about now. You know, if you have a good use of proceeds and you can point to something that's very tangible in the investor's mind, and that tangible deliverable is 6 months away, 9 months away, 12 months away, that's the kind of deal that people want to fund. They want to help you solve a problem. So funding towards that inflection point and making sure that you leave enough money on the table so that they feel adequately rewarded, because they are the ones providing the capital to help you get there. And then keep, you know, all investor prospects as informed as possible. This generally takes the form of some kind of an update every month, maybe every 2 months, but I think every month is good. Something between a 1 and 2 page update, where the business is, what challenges you faced, what wins you've had. And I really found that the biggest impact comes from situations where the founders are as honest and transparent as possible. We all know this is going to be a hard time, so might as well be upfront and forthright with respect to the information that's being communicated. I think that really goes a long way. The times for arm waving and promising the dream, those days are a bit over. Just be honest with where your business is. And then find other ways to add value if you're stuck. You're going to be stuck. It's inevitable. VCs get stuck trying to raise money for their funds. Entrepreneurs are stuck raising money for their companies. There are times to push and times not to push. Don't push on a string. If you don't feel like this is a time to have productive conversations, there's a ton of other things you can do to help your story. Most of it revolves around building that credibility aspect as it relates to raising capital when the time is right. So look to round out your board, look to round out your advisors. Advisors are fantastic resources because effectively they are free if you can attract them. Chip away at your technical debt. Every company has a ton of technical debt. This is a time to address it while you have a moment to breathe. Build out your data room, and that data room will be a reflection of you when it comes time to present it to an investor. So make sure you've ticked as many buckets as possible and make sure that it's clean and concise and organized in the way that you would like to see it. Try to get out for virtual coffees, talk to investors, to contacts, to customers. Really just keep in the dialogue. It'll get you away from your computer screen. It'll get you away from worrying. Improve your knowledge of the competitive landscape. This is something where I think tons of entrepreneurs fall down. I feel like they're not necessarily upfront with who the real competitors are. They don't know what those competitors are doing. So take the time right now to do demos of all of your competitors' products. Make sure you know them inside and out. Make sure you understand how your product can win, and not just in a grid that's sort of 5x5 with little check marks about what you do that's different than your competitor. Really understand what it is that you do. Because if you don't have enough of a differentiation, then you don't have a business. And so this is a great time to get up to speed on some of those things. And as I say, it's a part that I think a lot of people fall down in the diligence process by not having a good handle on that. And try to work with one of your clients to write a white paper. Again, get as much collateral produced during this time as you can. It's going to go far for your investors. It's going to go far for you to attract further clients. Again, something that's often overlooked just because time is such a valuable resource. And update your online presence. I know I'm guilty of this. You got to be staying current, etc. So that's all I got. Please feel free to reach out anytime. There's a ton of material that I presented a more sort of longer form factor of this presentation. If you want to reach me, I'm available. And thank you very much for your time.
Thank you so much, Scott. That was great and all-encompassing. We are going to do a couple of things here. We're going to move over to the other side of the conversation. So we've got Vincent from Local Logic who's going to share his screen now in a minute. I'd remind everybody that we'll be sharing this whole video on the RIC Centre website after the fact. So you can go and have a look at it again and stop and fast forward and do whatever you need to do from that perspective. If you want to get some of the detailed multiples that Scott talks about, etc. We're also running just a little bit long, so I think we're going to bleed over by 5 minutes or so if we get good Q&A at the end. So don't feel like you're not going to have any time to ask your question. We've already got 3 or 4 questions in. We're going to let Scott share his screen now and take us through, Vincent share his screen and take us through his pitch, and then we'll be sharing all of the questions after the fact and asking people to weigh in. So at this point, Vincent, it's over to you, and thanks so much.
Awesome. Well, thanks for the intro. Yeah. So you guys can see my screen? All good? Great. Yeah, so Local Logic, we're a company, we were founded in early 2015, based out of Montreal. Essentially what we do is develop vertical software for real estate investment decisions. So I'll give you a brief overview of the company, who I am, and then I'll kind of go in. I highlighted 4 key steps, I guess, in adapting to the situation and raising capital through this time. So quickly, We're a team of urban planners, engineers, data scientists, and real estate experts. Essentially, the company was founded out of the master's program in urban planning at McGill University. We realized there was all this data on cities, not much was being done with it, and we really believed that real estate was going to be the next asset class to be able to go quantitative. So similar to what happened in fintech. So I put a quick screenshot of some of the team members here. This is our new reality, all working from home over Zoom. So this was a team meeting a few weeks ago. Essentially, the problem is that investing in real estate is really, really hard. And this applies to both consumers, professionals, property managers. It's hard because there's so many factors that goes into investing in real estate, and there's really not that much data. And so what we did was we amassed thousands of sources of data and essentially tried to quantify what it's like to be at a specific address. And by quantifying that, we're essentially creating more transparency, efficiency in the real estate transaction process. And so we licensed this data to both large real estate websites across Canada and the United States. So we're on Realtor.ca, Remax, Redfin, and essentially helping home buyers search for properties that are going to fit their lifestyle criteria. And through those implementations, well, we gather a ton of data on what people are actually looking for, and then we package that information, give it back to those consumers for them to make more informed decisions, but also work with large institutional real estate developers, investors, all of that, in order to make their process more efficient, more data-driven, essentially de-risking the way that they do business. And so we do that through some consulting, but we're really building out a platform in order to automate that process. So I think before I get going in the way that we approached fundraising, I think one thing to remember and to be aware of is that this situation is very different from other financial downturns, where this is really a human crisis, not a financial one. And it has an impact on yourself as an entrepreneur. It has an impact on your staff, on your family members. And I think that's a really important starting off point to the conversation, because you need to be in tune with where you're at and what you're able to do in order to deploy the resources that you have to throughout the fundraising process. And so, Scott, you're gonna laugh. I have a very similar slide to you, where essentially it is a form of grief that you're going through, where the business that you had 60 days ago no longer exists. And I wouldn't say that the most important is to get to acceptance. I think it's to realize where you are in this path. And by realizing and being introspective and understanding where it is that you stand as an entrepreneur, well, then you can recognize the biases that you have in the decisions that you take, address those, and then move on. One thing to be really cautious about is unfounded optimism. I think as entrepreneurs, we also want things to be going great. We often feel like we have to talk about our business as if it's going perfectly. A lot of the times it's not the case. And so I think it's a time for us to be really, really realistic, honest with ourselves, honest with our team, honest with the investors that we're going to speak with, in order to really plan the right next steps. Step 2, get your ship in order. And so I put this slide in a fundraising update because I really believe that fundraising is kind of the final thing you do after building your business. As an entrepreneur, what you're doing is building an awesome business that you think is going to change the world. And then fundraising is just a process of you talking about what you've accomplished, right? It's a representation of all the work that you've done in the past 12, 18, 24 months. And so when the crisis hit, you absolutely need to go and look at your business and say, well, okay, what's happening? How is this going to be impacted? What do I need to do in order to adapt to this situation and then represent my business in the best possible way towards investors? So these are the guiding principles that we did the first week that we all went remote. Essentially, we kind of scrapped all our plan and said, okay, well, there's 3 guiding principles that we're going to go off of: support each other, mitigate losses, and gain ground. And those have been kind of the edges of the sandbox in which we've been playing and using them in order to guide our decisions as to what we're doing in terms of strategy. So first thing, take care of your people. So check in with your team to understand what they're going through, what their reality is. And this is, for you to be empathetic, but also for you to understand what resources you actually have access to. We've had team members with 3 children that, really can't work a full 40-hour week. And so you have to be realistic and you have to adapt your strategy accordingly. Second one, and this is super important, it's understand and track the crisis and your business. So I'm sure most of you have dashboards, have KPIs that you track. You need to double down on that, because you need to understand exactly what's happening and what will happen to your business in order to represent that to investors, right? So you need to be on top of the number of deaths, of cases of COVID in your area or in the geographies in which you operate. You need to have a good idea of what's going to happen, how the economy is going to reopen or not, because those are some of the information that you're going to use to make your decisions as to strategy and what you're going to do for fundraise. You also need to start tracking macroeconomic KPIs. So in our case, it's all about real estate. What's happening to the real estate industries? What are the transactions that are occurring? Are there new listings coming on the market? Getting those key KPIs gives you a good understanding and enables you to understand what's going to happen down the line to your customers, essentially, and to your revenue. Second one is talk to your customers. We made sure to check in with each of our customers. And this is really an opportunity for us to mitigate losses, but also gain ground. So checking in, hey, how you're doing? What's your business look like? What are the changes that you're seeing on the market? How can we help, right? And being there so they think of you when they have a problem that they want to fix or when they're not sure about something. And so they'll call you back and be like, well, actually, this is the situation I'm facing. So it's a great way to check in and mitigate those losses, but there's also potential new revenue that can come out of those conversations. Quarterly planning is dead. So we used to do OKRs, so objectives and key results, on a quarterly basis. We scrapped all our OKRs and we're doing 30-day planning cycles. So essentially, during those 30 days, we're looking to learn as much as possible, iterate, and then adapt to that situation. And we're doing weekly cash flow analysis. So every single expense that we have as a company, I actually approve right now. And that's just to be very, very cautious as to what we're doing. And again, it's all about optionality, keeping as much cash as possible. So when you see an opportunity, you can strike on it. Essentially, what you're trying to do as a company and from a management team perspective is about creating an environment where it's okay for you as a management team to change directions quickly and where the team is going to be able to follow you if something dramatic is happening in the space. So first one, get your ship in order. Third step, understand if and why you're raising. So, I think the first question is really, do you really need to raise this money? Is this the right time for your business? Or is this kind of the reality check to say, well, it's a great opportunity for people to say, well, you know what? This business isn't working, or this isn't quite what I want to do, or, I've been thinking about making this pivot. Well, maybe this is a great opportunity for you to try that out, right? Before you go in the process of raising money. If you do choose to raise money, I think, the consensus is that you want to make it to Christmas 2021 in terms of payroll. So you have to raise a substantial amount of money so that you're not trying to go back and raise, in 6 months to a year, because who knows what the economy is going to look like then. So yeah, have a clear why now. What's going to happen in the next 12 to 18 months? You really have to figure out what are the things that are going to be really meaningful, the opportunities that you think are going to come up that you want to be able to capitalize on. And Scott touched on this a little bit. You're raising money to be opportunistic and figure out or adapt your business to the way the market is going to change over time as this crisis goes through. And then again, it's planning your next capital raise. So what do you think you're going to raise at what valuation? Is it realistic to get there given the resources that you're raising today? So having that long-term plan and figuring out, well, okay, in 18 months, I'm going to have to go back and raise more money. I'm now going to have, triple the headcount I do. I'm going to have this burn. This is the revenue number I need to hit, which means this is the revenue multiplier I can get on valuation. Is that something that's realistic? So doing that math now so that you're not setting yourself up for failure in 18 to 24 months. One thing that we're seeing is you need to have more rigor in your plan. I think the bullshit meter is much stronger now from investors. Scott touched on this, people are doing more diligence. They're less likely to take on risk. They're looking to minimize the risk as much as possible. As a founder, you have to kind of have a list of assumptions, a list of risks for your business. And essentially, you're trying to figure out how you can check off those risks through data points, through customer traction, whatever it may be, in order to present your business in the best way possible, and also aligned with the risk factors that you're going to see your investors talk about or pinpoint. Be realistic and honest about the impact of COVID-19 on your business. I think what I saw was investors that were really understanding of like, look, this is happening. It's happening to everyone. It's not because your business is bad. So to go in there and say everything's good just kind of will not work with investors. And frankly, you're setting yourself up for failure. So, really understand, is your business going to do better with COVID-19 or is it going to do worse? And be upfront about that and make that in line with why you're raising now. Show them this great opportunity for you to show them what you've learned. It's been around 60 days that we're in this situation. Show them the progress you've made. Show them the steps you've taken to mitigate risks. Show them how you've reacted as a leader, as a management team. How did you morph your business and be agile in this situation? I think that's a really good opportunity for you to demonstrate your leadership and management skills and say, well, look, we've been able to bounce back. It's not exactly the situation we thought we were going to be in or wanted to be in, but these are the steps we've taken. And I think that's a big check mark to one of the big risks that they're looking at. More practical, have a COVID-19 slide. Show this stuff in your deck. I think investors are always going to ask for it. Be ready, have it prepared, and show exactly what the situation is, the impact on your business, what you've done. Fourth step, understand who you should raise from. Scott touched on this. I think this is super important, where there's so many investors out there that invest in very specific thesis. Don't waste your time, reaching out to everyone and anyone. What we did was we built an investor target list off of Crunchbase. And essentially we had, I think at first we have close to 100 VC firms which had either invested in or had a thesis in investing in businesses that were similar in nature to us, so in the real estate space and prop tech related startups, or investors that were clear prop tech or had a vertical for prop tech or had a partner attributed to prop tech as a specialty. There's so many funds out there that it's possible to build quite a substantial list on a very specific thesis. And then you prioritize investors based on the fit that you can gauge. And then of course, the relationship you have with them. I think it's, you're going to see investors that are not going to invest if they haven't met you in person. So others like Scott is going to invest over Zoom, and that's great. I think you have to understand that. You have to figure that out really quickly. I know there's some lists online that Hockey Stick did. People that are going to be investing are going to be quite vocal about it because they're looking for deal flow. Now, the reality is that they might not be investing today, but in a week, they might start investing and their thought process might have changed or the situation might have changed. So I think it's important to prioritize the effort and the conversations you have with investors that are currently investing, but make sure to check in regularly with all the other investors on that list through an update email or through a quick check-in of like, hey, has the situation changed? This is what we're up to. And then I think the last one, which is true even if you're not raising during COVID, is get to know quickly. A lot of VCs want to just be there, figure out who's going to be there, who else is going to be in the syndicate, and essentially you're going to waste your time. So try to get to know really quickly so you can focus your efforts on the ones that are going to be more likely to invest or that you think could bring you more value. And then the last point here is, looking for money from a VC is very much a two-way relationship where the VC is going to be putting in all this effort to do diligence on your company. You need to do the same thing because essentially you're going to be in partnership with this company or this individual for the next 5, 7, 10 years. And so you need to make sure that you want to work with these people, that they're going to bring value long-term, and that you're going to be aligned in 5 years when things don't go so well. And then my last slide, and I think this is one that is important to me. It's a quote by Vincent-Charles from Patagonia, and he said, "The word adventure has just gotten overused. For me, adventure is when everything goes wrong. That's when adventure starts." And I think that's a really, really good representation of what's happening right now. As entrepreneurs, we're in this for these moments. This is exciting. It's different. Your challenges suddenly changed. Things have gone wrong. Now it's adventure, and it's all about you meeting that moment and making the best of it. It's not what we wanted, but it could be fun, and we could grow out of it and be better positioned at the end of it. That's it.
That was great. Thank you so much, Vincent. And Scott, that was, I think, a really good kind of two sides to the conversation and a really good balance for our entrepreneurs there. We still got over 50 people online, and I think I'm going to go over 5 or 10 minutes if there's enough traction there. So Scott, there was a couple of messages that were posted in chat, and you responded to them in chat. Maybe you could just give us a verbal answer for those that weren't tracking the chats for those questions that were there already. So there was a question about multiples that you answered. Maybe.
Oh, right. The first question was about a convertible note. Very common to use a convertible note. As the entrepreneur, go for a safe if you can, but convertible note is certainly preferred from an investor perspective. And yes, I think you would be required to have a valuation cap. The second question was around multiple lifts from one round to another. I kind of think like this: from seed to A, you want 2 to 3 times as the investor. Again, if everything kind of works out reasonably well. And from A to B, you're looking for 2 times lift, approximately. These are just sort of rules of thumb. There's obviously no magic to them.
Okay, that's great. So folks could check in and post any questions they have in chat here. And what are we saying? Oh, somebody asked what a data room is. I think many of us know that, but perhaps you could answer.
Just one place that has all pertinent information with respect to IP, financials, client lists, forecasts, business structure, employee backgrounds, and employee contracts. Basically everything that an investor would want to look to see when they're doing diligence on you.
And it's basically a representation of the firm, right? So you're saying that the more professional the data room, the more positive your perspective of the organization.
Yeah, make it neat, clean, simple, hit the things that are going to be what an investor is trying to look for, and have it organized so it's easy to digest, so that you avoid the back and forth where an investor asks you, the same question 3 times, but really it's hidden away in some file on some Excel tab. Just make it simple to understand.
Yeah, great answer. I'll ask you both, but maybe Vincent first. When you talked about, doing due diligence on the investors in the community, you mentioned prop tech basically as a category. Sounds like you're a machine learning company as well. So do you look for investors specifically vertically like that in property technology, as opposed to there's a lot of funds that are out there that are more horizontal around a technology like artificial intelligence?
Well, I mean, the situation was that we had already taken on VC investments from generalists or from other niches, and our board and kind of the people surrounding us, we wanted more expertise in prop tech and building an AI data company. And so we were focusing our search around those 2 verticals. But that was because that's what we needed to balance out our advisorship and the people surrounding our company. I think, you have, as an entrepreneur, you have to figure out, okay, well, what am I lacking in terms of my investors and the people around me? And then, when you're raising capital, if you're looking for smart money, which you should be, you're then able to identify the niches or the types of investors, and then that allows you to go and focus and build out that list through Crunchbase or whatever it may be.
Okay, good feedback. Anybody else? David Harris-Pilati, do you have anything you want to ask?
That I want to ask?
Yeah.
I don't think so. I love both presentations. They were terrific. Scott, as usual, did a great job, and Vincent as well. I can see why Scott was interested in your company, and you're a great presenter. I think the 30-day heartbeat was interesting, Vincent, in terms of how you were setting your objectives and keeping things very nimble. I mean, it reminds me a little bit of sprints, code sprints and agile development. It's almost like taking that and applying it to the whole company. I guess I would just caution you as an investor myself, as a venture capitalist. To me, we're investing for the long term, and you have to think beyond 30-day sprints. So I agree, being nimble is important, but you have to complement that with what's your strategy, what's your longer term plan, how you're going to return, build value to your investors, and not just sort of keep everyone on their toes. Because I would think, a year or 2 of 30-day sprints would get people very fatigued, and you may actually not end up where you want to be ultimately. So I think it's just important to find that right balance of, understanding the tactical short-term priorities, as well as the longer-term strategic goals and mission that you're trying to accomplish, which, investors are really looking for. That's what's going to set you apart in terms of raising capital is, what's your vision? Is it big? Is it distinctive? And what's your ability to execute against that plan, which gets to those 30-day sprints, but it's not exclusively that.
Yeah, for sure. I couldn't agree more. I mean, when we were doing quarterly planning, it's saying, okay, well, we have 4 quarters in a year. This is what we want to accomplish this year. This is what we're trying to do as a business and what our mission vision is. And then you kind of backtrack from there. Quarterly planning in a situation where things are changing daily, which is no longer possible. So saying, recognizing that and then changing it to a 30-day sprint and weekly cash flow analysis enabled us to kind of really hone in on what we wanted to do. As things progressed, we saw a change, from day to day to week, and now probably going to be more month to month. So it allows us to have a little bit more long-term time horizon. But there's really 2 reasons why we did it that way. Number one is we needed to react. We needed to figure out how our business was going to evolve. But it's also something around management capital, saying if you're setting goals and you have a kickoff for OKRs for the quarter, and you're telling the team, this is the direction you're going in, this is the KPIs that we're going to follow, and then suddenly the next week something happens and you have to adjust it, it becomes harder to kind of steer that ship and make that change. So doing it by 30-day cycles enables us to say, well, look, okay, things might change, and this is where we're going, but we'll give you the context as to why we're making those shifts. And what we found is that the team was able to react and understood and kind of gave us that bandwidth to figure things out as more info came in. And that was really beneficial. And we have to figure out how that stays after this crisis.
Great question, great answer. I'm going to ask one more before we go. We have both a Canadian investor and a Canadian entrepreneur here. This is really a global crisis we're in. If I could get both of your feedback, are you hearing different things internationally relative to how they're responding to this challenge, specifically US right at the moment?
So
Scott,
from a VC perspective, I can tell you that my sense is that Canadian VCs are much more inwardly focused. They're really focused on preserving the companies that they've already invested in and helping them have enough runway to get through this. In the US, I think partly because there is more capital generally available, there is a much more willingness to invest through the downturn and to push forward with net new investments right now on a relative basis. I mean, everyone's more inwardly focused, but on a relative basis, Canadians are perhaps not surprisingly on the more conservative side.
So Scott, does that
interesting?
From your
if
perspective?
I could jump in on that.
Okay, go ahead.
Yeah, I actually would have said the opposite, and Scott and I like to disagree, so I'm going to disagree. I think in the US, you have to separate Silicon Valley from the rest of the US because there's not just one US venture capital market, there's several, and they have very regional differences. So I would say Silicon Valley has been impacted the most in our experience, but they are just nowhere in terms of looking at new deals, and the valuation compression has been the most severe, and that's because that's where the bubble had the most air in it, if you will, and so there was a lot more gravity that took over when the bubble was burst. I think in the eastern U.S. it's not quite as bad, but it's certainly worse than what I've experienced in Canada. I think in Canada, because we're more conservative, the amplitude of the sine wave tends to be a little bit less. So we're certainly seeing, Canadian investors, some of them moving ahead almost as if things didn't really change much, which I think is perhaps not the wisest course of action, but that's what some are taking. But in general, most VCs are still looking at deals. They're working with their companies. They're even doing up rounds from time to time. So maybe it depends on the stage you're looking at as well. I think it varies along the spectrum, but yeah, I would just say that we're seeing quite a variety, but we, our portfolio, for example, at Green Soil is 2/3 at U.S. companies, 1/3 Canadian by dollars, and our U.S. co-investors are much more severely impacted than our Canadian co-investors.
So it's Paul here. I'm going to cut it off at that point. Sounds like an opportunity for a conversation as a follow-up. I can't tell you how much we appreciate at the RIC Centre and our partner incubators and accelerators your time today, Scott and Vincent. Really, really useful conversation for us. We saw a large proportion of folks kind of hang around right to the end and bleed over into the next hour. We don't often see that. So, you know that it was well received. We will be posting this this event on our website within the next couple of days. And we will have another event in this series in 2 weeks. We're just finalizing the topic now. Stay tuned and we'll be messaged. And thanks everybody for joining us today. Thanks one last time to Scott and Vincent. It was really appreciated. You guys have a great day.
Thank you.